mixed group is a form of group in which the parent company have both direct and indirect investment in another company. The form of group in which the parent company have both direct and indirect investments in another company, that is mixed group. In other words, mixed group structure is where the ultimate parent and subsidiary have an interest in another entity. Mixed group is a form of group in which the parent have both direct and indirect interest in another company or in a subsidiary. Mixed group is a form of group in which the parent company, in which the parent have both direct and indirect interest in another company. Or I said it is the type of group structure where the ultimate parent and subsidiary have an interest in another company. In other words, mixed group or mixed group structure is the form of group in which the ultimate parent and subsidiary, ultimate parent and subsidiary have an interest in another company. Mixed group is the form of group in which the ultimate parent and subsidiary have an interest in another company. That is mixed group. Now, for example, let me say H acquired 80% of equity interest of X1 Limited on 1st January 2023. Both H and X1 had acquired 60% and let me say 30% and 60% of S2 2 years ago. Now, H acquired 80% of equity interest of S1 Limited on 1st of January 2023. Both H and S1 had acquired 30% and 60% of S2 2 years ago. Let me put respectively. That means H acquired 30% of S2, S1 also acquired 60% of S2. Now, if you want to draw the group structure will appear just. H acquired 80% of X1. S1 Limited on 1st of January 2023. both H and S1 had acquired 30%. That means H acquired 30% and S1 acquired 60% of S2. S1 acquired 60% of S2. S1 acquired 60% of S2, while H also acquired 30% of S2. S1 acquired 60% of S2, H acquired 30% of S2, while H also acquired 80% of S1. Another word for mixed group is D-shape. D-shape group. D-shape group structure. That is another word. You know, if you look at this shape, it is form of letter D. That is why mixed group can also be called D shape. What are the steps for solving problem involving mixed group? Step number 1. Steps for solving a mixed group structure. Number 1, draw the group structure. In my previous illustration, I've drawn the group structure. This type of diagram is called the group structure. This is the diagram for mixed group, D-shaped group. Step 2, determine the effective interest of parent company in subsidiary company. You determine the effective interest. Remember, I've told you that in a mixed group structure, the parent company will have both the direct and indirect interest in the subsidiary company. So, to determine the effective interest, you have direct interest. From our earlier illustration, H acquired 30% of S2. The 30% stake of H in S2 is direct stake, which is 30%. Then we also have indirect. The indirect stake, that will be the product of H stake of 80% in S1 and that of S1 in S2, that is indirect. 80% times 60%. So you have 80% times 60%. That gives us 48%. If you add 30% and 48%, then you have 78%. This 78% is the effective interest. Effective interest of parent in subsidiary. The remaining balance to make it up to 100% is your NCI, non-controlling interest, and that is 22%. So the sum of 78% and 22%, that is 100%. That is step 2. You determine the effective interest of the parent in the subsidiary, in the sub-subsidiary company. Step 3. Determine the consideration to use in calculating goodwill on acquisition of the subsidiary company. Determine the consideration to use in calculating goodwill on acquisition of the subsidiary company. To determine that consideration, you have the direct cost of parent in subsidiary. That is the consideration the parent paid to acquire its stake in the subsidiary company. Based on my earlier illustration, the price or the consideration paid by the parent in acquiring the 30%, that is what I mean by this direct cost. Consideration paid by the parent company in acquiring the 30% stake. Then you also add the indirect cost of the parent. Indirect cost of the parent will be obtained by applying the percentage of the parent in the subsidiary company. Based on my earlier illustration, remember parent acquired 80% of S1. That 80% is the percentage of acquisition of parent in the subsidiary. You apply that 80% times the cost of subsidiary in subsidiary. That is the cost of S1 in S2. How much does S1 pay in acquiring its stake in S2? Remember, what S1 acquired in S2 is 60% based on my earlier illustration. You are not going to use that 60% to apportion the cost. You use the 80% what parent acquired in S1. That is the percentage you are going to use. You use it to apportion that cost. So whatever you have, that is the indirect cost of the parent in the subsidiary company. When you add it and the direct cost, then you get the consideration to use in calculating goodwill. The remaining 20% not acquired is the cost attributable to NCI. Cost attributable to NCI. So when you calculate your non-controlling interest in the usual way, you are going to deduct this cost from your non-controlling interest. That is, you are going to reduce your NCI by what you've obtained. That is, for this purpose now, you are going to calculate 20%, not 40%. Take note, 20% of cost of subsidiary in cost of subsidiary in subsidiary. So whatever you obtain, you subtract it from your non-controlling interest calculated in usual way. Then step 4, present the summary of each of the subsidiaries' net assets. Present the summary of each of the subsidiaries' net assets. The summary of each of the subsidiaries' net assets. You present it. If you have been following me in this channel, then you will have been used to this. Please, I will advise you watch my earlier videos. I have over 20 videos on group accounts. Please go back to all those videos and watch them for better understanding. Then steps 5, determine the goodwill on acquisition. You are going to calculate your goodwill in usual way. Positive goodwill can be aggregated. If you have positive goodwill, maybe the first goodwill, first subsidiary, you have positive, the second one positive, then you can add them together. But if you have one to be positive and one negative, you can't net it. Offsetting is not allowed. Take note of that. Remember, negative goodwill is now to be called gain on bargain purchase. Step 6, determine the non-controlling interest for consolidation purpose. Determine the non-controlling interest for consolidation purpose. Determine the non-controlling interest for purpose of consolidation. Then step 7, determine the consolidated retained earnings. Determine the consolidated retained earnings. I believe you must have been used to this, but I'm still going to take a comprehensive work example from the past examination question, the question that is loaded. So you should be expecting that from this video. Step 8. Prepare the consolidated financial statement. Prepare the consolidated financial statements. Remember to incorporate all necessary adjustments. All necessary adjustments have to be incorporated. Intergroup balances should be eliminated. Please take note of the principles I've explained in my previous videos. I will advise you watch all other videos I have in this channel. I have a playlist on group and a playlist on different subjects. I have playlists in each of the courses in your corporate reporting, financial reporting, and others. Your SBR, strategic business reporting, I have playlists in them. Please, I will advise you go back to those playlists. Watch those videos one after the other for better understanding. Now, example, the draft statement of financial position of OMI PLC, Ruwa Limited, and Mili Limited as at November 30, 2020 are as follows. We have OMI PLC, Ruwa Limited, Mili Limited, amount in millions of naira. We have non-current assets. Property, plant and equipment, 4,920, 2020, 1024. Investment in Ruwa Limited, 2,560. Investment in Mili Limited, 640 and 400. Total of the non-current asset for OMI PLC, 8,120, 2,420, and 1,024. We have current assets, inventories, 1,200, 540 and 260 for OMI PLC, Ruwa Limited, and Mili Limited, respectively. Trade receivables, 960, 420, 196. Cash and cash equivalents, 360, 200, and 320. Total of current assets, 2,520, 1,160, and 776. Total assets, 10,640, 3,580, and 1,800. Then we have equity and liabilities. Equity, share capital, 6,000, 2,000, and 800. Share premium, 1,200, 400, and 200. Revaluation reserves, nil, and 280. Retained earnings, 2,500, 800, and 240. The total of the equity is 9,700, 3,200, and 1,520. Non-current liabilities 540, 100, and 80. Current liabilities 400, 280, 200. Total equity and liabilities 10,640, 3,580, and 1,800. Additional information. 1. OMI PLC acquired 80% ordinary share capital of Ruwa Limited on December 1st, 2017, when the retained earnings were 400 million naira. The fair value of the net assets of Ruwa Limited was 2.840 million. Any fair value adjustment related to net current assets, and these net current assets have been realized by November 30, 2020. There had been no new issue of shares in the group since the current group structure was created. Note 2. OMI PLC and Ruwa Limited had acquired their holdings in Mili Limited on the same date as part of an attempt to mask the true ownership of Mili Limited. OMI PLC acquired OMI PLC acquired 40% and Ruwa Limited acquired 25% of the ordinary share capital of Mili Limited on December 1st, 2018. The retained earnings of Mili Limited on that date was 200 million naira, and those of Ruwa Limited were 600 million naira. There were no revaluation surplus in the books of Mili Limited at December 1st, 2018. The fair value of the net assets of Mili Limited at December 2018 were not materially different from their carrying amount. 3. The group operates in an information technology sector and has incurred a significant amount of expenditure on the development of various internet products. Those costs were formerly written off to statement of profit or loss as incurred, but then reinstated when the related internet products were brought into commercial use. The reinstated costs are shown as development inventories. The costs do not meet the criteria in IAS 38, intangible assets, for classification as intangibles, and it is unlikely that the net cash inflows from these products will be in excess of the development costs. In the current year, Ruwa Limited has included 80 million of these costs in inventories, of which 20 million naira related to expenditure on a product written off in periods prior to December 1st, 2017. Commercial sales of these product has commenced during the current period. The accountant now wishes to ensure that the financial statements comply with IFRS as regards this matter. 4. Ruwa Limited had purchased a significant amount of new internet equipment during the year. The cost before trade discount of this equipment was 200 million naira. The trade discount of 24 million naira was taken to the income statement. Depreciation is charged on straight line basis over 6 years period. Note 5. The policy of the group is to state the property, plant and equipment at depreciated historical costs. The group changed from the revaluation model to the cost model under IAS 16 property, plant and equipment in the year ended November 30, 2020, and restated all its assets to historical cost in that year, except for the property, plant and equipment of Millie Limited, which had been revalued by the directors of Millie Limited on December 1st, 2019. The value were incorporated in the financial records, creating revaluation surplus of 280 million naira. The property, plant and equipment of Millie Limited were originally purchased on December 2018 at a cost of 1.2 million. The assets are depreciated over 6 years on straight line basis. The group does not make an annual transfer from revaluation reserves to retained earnings in respect of the excess depreciation charge on the revalued property, plant and equipment. There were no additions or disposal of the property, plant and equipment of Millie Limited for the 2 years ended November 30, 2020. Note 6. It is the group's policy to value non-controlling interest at acquisition at their proportionate share of subsidiaries' identifiable net assets. Note 7. During the year, the directors of OMI PLC decided to establish a defined benefit pension scheme for employees of the parent company and contributed cash to it to the tune of 400 million naira. The following details relate to the scheme as at November 30, 2020. We have amount in million, present value of obligation 520, fair value of planned assets 500, current service cost 440, interest cost, schemes liabilities 80, expected return on pension assets 40, actuarial gain 60. The only entry in the financial statement made to date is in respect of cash contribution, which has been included in OMI's PLC trade receivables. The directors have been uncertain as to how to deal with the above pension scheme in the consolidated financial statements because of the significance of the potential increase in the charge to the statement of profit or loss relating to the pension scheme. They wish to recognize immediately any actuarial gain in statement of profit or loss required. Prepare the consolidated statement of financial position of OMI PLC of OMI Group for the year ended November 30, 2020 in accordance with relevant IFRS. This question is obtained from ICAN May 2023 Corporate Reporting. Solution. So the first thing is to draw the group structure. Group structure. Back to the question. Note 1. You were told that OMI PLC acquired 80% ordinary share capital of Ruwa Limited on December 1st, 2017. If OMI PLC acquired Ruwa Limited, so you have OMI PLC acquired 80% of Ruwa Limited. So, back to the question. That is the note as regards the acquisition of Ruwa. Note 2 again. OMI PLC and Ruwa Limited acquired their holdings in Millie Limited on the same date as part of an attempt to mask the true ownership of Millie Limited. That is to show that both OMI PLC and Ruwa, they both acquired Millie Limited. So Omi PLC acquired 40%. Omi acquired 40%. And Ruwa Limited acquired 25%. Ruwa Limited acquired 25%. So 25%, that is Ruwa acquired 25% of Mili Limited, and Omi PLC acquired 40% of Mili Limited. So that is the group structure. So this is D shape. The next thing is to determine the effective interest of Omi PLC in Mili Limited. Now let's determine the effective interest. Effective interest of Omi PLC in Mili Limited. So Omi has a direct interest. We have direct. Omi acquired 40%. That 40% is direct. Then we also have indirect. Remember, Ruwa acquired 25%. I've told you that you have to find the product of this. 80% by 25%. 80% by 25%. That gives us 40% as well. 40% plus 40%, that is total 80%. Therefore, NCI will be 20%. Total 100%. That is the effective interest of Omi PLC in Mili Limited. Then I've told you that the consideration paid to acquire Mili, the consideration paid to acquire Mili for goodwill purpose, for goodwill calculation purpose, you have to determine the consideration paid to acquire Mili. And I've told you that that consideration will be divided into two. We have the direct and indirect. I've told you that to calculate that of indirect, it is the percentage of Omi in Ruwa you are going to use, which is this 80%, not 25%. You calculate 80% of the amount paid by Ruwa Limited in acquiring its stake in Mili Limited. 80% of the cost of Ruwa in Mili. That is what you need. Why the remaining 20%? I've told you that that will be used to reduce the non-controlling interest. When you calculate your non-controlling interest in the usual way, you are going to deduct 20% of that cost of the consideration paid by Ruwa. 20% of the consideration paid by Ruwa in acquiring Mili. You deduct 20% of that cost from your non-controlling interest calculated in usual way. Remember, you were given investment in Ruwa Limited in the column of Omi PLC. That is to show that Omi PLC paid 2,560 million in acquiring its stake in Ruwa Limited. That is the consideration for the acquisition of Ruwa Limited. Then, investment in Mili Limited. Remember, Omi PLC acquired 40% of Mili. So, this 640 million is the amount paid by Omi PLC to the shareholders of Mili in acquiring the 40% stake. Why this 400 million, you have it in the column of Ruwa, is the amount paid by the shareholders of Ruwa Limited in acquiring their stake, which is 25% stake in Mili. So it is this 400 million paid by Ruwa that we are going to apportion. We are going to apportion this 25%, 400 million. Remember, Omi PLC has direct. This 640 million is the direct cost of Omi. This, to get the indirect now, you calculate 80% of this 400 million. Now, cost of acquisition. Cost cost of acquisition of Millie Limited. We have direct cost which was given as 640 million. 640 million is the direct cost. The indirect cost which was given to be 400 million. I've told you that this 400 million, we are going to apportion it. It is 80% that will be used to apportion the 400 million, not the effective interest, and not 25%. It is 80%, parent company's stake in subsidiary. That's what we need. So we have 80% of 400 million. That gives us 320 million. If you add 320 million to 640 million, then you have 960 million. The remaining 20%, you are going to deduct it from your NCI, the one calculated in usual way. 20% of 400 million giving us 80 million. When you calculate your NCI in usual way, you are going to subtract 80 million naira from it. You subtract 80 million naira from your non-controlling interest calculated in usual way. Now, having established the group relationship, the effective interest of OMI immediately has been determined or ascertained. Then we equally determine the cost of acquisition of Millie. Then the next thing is to present the summary of the net asset. Working 2. Summary of Ruwa Limited net assets. So the net asset, you have post acquisition retained earnings. You have the one at the date of acquisition. Then we also have the one at the date of consolidation. I've told you that DOC means date of consolidation, DOA date of acquisition, post-acquisition retained earnings. Now, what are the net assets of Ruwa Limited? I've told you that the simple definition of net asset is equity. Now, the equity, this is Ruwa Limited column, this is Ome, this is Ruwa, and this is Millie. Equity comprises share capital 2,000, share premium 400, retained earnings 800. Now, let's write them out. Share capital, $2,000. Share premium, $400. Retained earnings of 800 naira. Note 1. OMI PLC acquired 80% ordinary share capital of Ruwa Limited on December 1st, 2017, when the retained earnings were 400 million naira. So we were given the retained earnings as at the date of acquisition of Ruwa Limited to be 400. So the share capital will still be, the DOA will still be 2,000. Then share premium at the DOA will still be 400. Then the retained earnings at the DOA, you were told the retained earnings at the date of acquisition of 400. 800 minus 400, then post-acquisition retained earnings will be 400. Back to the question. The fair value of net assets of Ruwa Limited was 2.84 million. So they are still referring to the same date of acquisition. We're having the fair value of Ruwa Limited net asset to be 2.840 million. So we have fair value of net assets at the date of acquisition 2840. Back to the question. Any fair value adjustment related to net current assets. You were told the fair value adjustment related to net current assets. And this net current asset had been realized by November 30, 2020. They have been realized. So fair value adjustment relates to non-current assets. If you add this plus this, 24 plus this 28, and here you have 2840. That means you have fair value adjustment of 40. Fair value adjustment, and you were told it relates to net current assets. So 40. Then you also have, you put it in DOC column. So this is 2840. Then what is the total of this? 24 plus 800 plus 40. This side is total 3240. That is note 1. Note 2. OMI PSC, this is the acquisition. This is the acquisition, the note on acquisition of OMI's, Millie's stake. That is note 2. Now let's go to note 3. The group operates in an information technology sector and has incurred a significant amount of expenditure on the development of various internet products. Those costs were formally written off to statement of profit or loss as incurred, but then restated when the related internet products were brought into commercial use. The restated costs are shown as development inventories. The costs do not meet the criteria in IAS 38. Intangible assets for classification as intangibles, and it is unlikely that the net cash inflows from these products will be in excess of the development cost. In the current year, Ruwa Limited, no, we are dealing with the summary of net asset of Ruwa Limited. In the current year, Ruwa Limited has included 80 million of these costs in inventory, of which 20 million relates to expenditure on the product written off. 80 million which has been included in the inventory, since it doesn't meet the recognition criteria in IAS 8. The cost do not meet the criteria in IAS 38. Since the cost does not meet the criteria in IAS 38 and it has been included in inventory, you are going to remove it from inventory. You deduct the 80 million from inventory when you are preparing the consolidated statement of financial position. And then you also expense it. You charge it as an expenses in the statement of profit or loss. You deduct it from profit or loss, or you just deduct it from retained earnings. 80 million of this cost in inventory, of which 20 million relates to expenditure on the product written off. 20 million is already part of 80 million. So this information, it may not be treated as relevant, since we want to write up the whole 80 million prior to December 20. Commercial sales of this product has commenced during the current period. The accountant now wishes to ensure that the financial statements comply with IFRS as regards this matter. So we have development cost. Development cost written off 80 million. I've told you that the DOC column serves as a memorandum column. So you want to deduct it from retained earnings. So subtract 80 million from retained earnings. That is, if you are subtracting it from retained earnings, that means you are deducting it from profit or loss. So you want to write it off. Then the same 80 million will be deducted from inventory in the statement of financial position. Back to note 4. Ruwa Limited had purchased a significant amount of new internet equipment during the year. The cost before the trade discount of this equipment was 200 million. The trade discount of 24 million naira was taken to the income statement. Depreciation is charged on straight line basis over 6 years. You were told the trade discount was taken to the income statement. So since it was taken to the income statement, that means it has been recorded as an income it has been recorded as an income in the statement of profit or loss. You ought not to have recorded trade discount in the income statement. So you are going to write off the 24 million you write off from the statement of 24 million from the statement of profit or loss. Then the same 24 million, since it has been treated as an income in the profit or loss, that means it has been recorded as an asset in the statement of financial position. You are also going to remove it from your asset. Since it has been recorded as an income in the statement of profit or loss, that is to show that it has equally been recorded as part of your PPE, an asset. So you are going to subtract the 24 million from your asset. If it has been recorded as an asset, that means depreciation will have been charged. We were told depreciation is a straight line over 6 years. That means depreciation has been charged on the 24 million. And the depreciation for the current year, you add it back. Since you ought not to have recorded the 24 million in your financial statement. So now, let's have the trade discount. Trade discount. You want to deduct it from profit or loss. 24 million. Since it has been recorded as an income before, that is why we are subtracting it. So I've told you, we don't use to record trade discount in the financial statement in line with the double entry. Since this has been recorded, then that means it has formed part of your income. At the same time, it has been recorded as an asset. So that means this 24 million, we are going to remove it from your PPE as well. You subtract the 24 million from PPE. And now that this thing has been recorded as an asset before, that means you will have depreciated it accordingly. So with the depreciation charge now, depreciation charge on this 24 million. No depreciation, you were told 6 years, period of 6 years. So you add back depreciation. 24 million divided by 6, that is 4 million. So you add back the depreciation charge. So we depreciated it over 6 years period. We were told depreciation is 6 years. So that is why we added the depreciation back. Note 5. The policy of the group is to state the property, plant and equipment and the depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16 property, plant and equipment in the year ended November 30, 2020, and restated all its assets to historical cost in that year, except for the property, plant and equipment of Millie Limited. So this has to do with Millie. Since we were told the fair value of the net assets of Ruwa Limited was 2.840 million. Any fair value adjustment relates to net current assets, and this net current asset had been realized by November 30, 2020. Since the net current asset have been realized now, so the fair value gain you have recognized here, so you are going to deduct it now. The fair value of net current asset, fair value net current assets realized. Since it has been realized, so you subtract the 40, this 40 million, which you have as fair value gain. Since it has been realized, so you subtract the 40 million. So now let's adjust the accounts. So we have 400 minus 80 minus 24 plus 4 minus 40. So this is total 260. Then here you have 2840. Then this column 3240 minus 80 minus 24 plus 4 minus 40. Then you have 3,100. So that is the summary of net assets of Ruwa Limited. Let's also have the summary of net assets of Millie Limited. Summary of Millie Limited's net assets. So we have DOC, DOA and post acquisition. So we have revaluation reserves. Then we also have retained earnings. Amount in million. So we have share capital, share premium. We have retained earnings. We have revaluation reserves. We also have retained earnings. Now, back to the question. The share capital of Millie, we have 800, share premium of 200, revaluation reserves 280, retained earnings 240. Share capital 800, share premium 200, revaluation reserves 280, and retained earnings of 240. The DOA share capital will still be 800. DOA share premium will be 200. Then revaluation reserves and retained earnings. Back to note. Omi PLC and Ruwa Limited had acquired their holdings in Millie Limited on the same date as part of an attempt to mask the true ownership of Millie Limited. Omi PLC acquired 40% and Ruwa Limited acquired 25% of the ordinary share capital of Millie Limited on December 1st, 2018. The retained earnings of Millie Limited on that date were 200 million. This is the pre-acquisition retained earnings. The retained earnings of Millie at the date of acquisition is 200 retained earnings. So we match that against the retained earnings. So this is revaluation reserves, and this is retained earnings. So post-acquisition retained earnings will be 240 minus 200. Then we have 40. Back to the question. And those of Ruwa Limited were 600 million. This 600 million is not relevant. It's not relevant. There were no revaluation surplus in the books of Millie Limited at December 1st, 2018. Remember, Millie Limited was acquired as of 1st of December 2018. So that's to show that since it was acquired 1st of December 2018, and you were told there was no revaluation reserve, no revaluation surplus in the books of Millie at the date of acquisition, that means pre-acquisition reserves of Millie will be nil. So pre-acquisition will be nil. That is to show that the whole 280 relates to the post-acquisition period. It relates to post-acquisition period. So that is why we put the 280 under revaluation. Back to the question. The fair value of the net assets of Millie Limited at December 2018 were not materially different from their carrying amount. So they were not different from their carrying amount. So the group operates in an information technologies sector and has incurred a significant amount of expenditure on development of various internet products. Those costs were formerly written off to the statement of profit or loss as incurred, but then reinstated when the related internet products were brought into commercial use. The reinstated costs are shown as development inventories because do not meet the criteria in IS 38. I think this has been considered. It relates to Ruwa. Note 4. Note 4 is also for Ruwa Limited. The policy of the group is to state the property, plant, and equipment at depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16 property, plant, and equipment in the year ended November 30, 2020. So the current year end, the change from the revaluation model to cost model, and restated all its assets to historical costs in that year, except for the property, plant, and equipment of Mainly Limited, which had been revalued by the directors of Mainly Limited on December 1st, 2019. Now, since the entity has changed to the cost model, the entity also applied the cost model to all its property, plant, and equipment if the financial statement were to comply with IFRS. So since this one doesn't comply with that model, the cost model, that means the entity's financial statement does not comply with IFRS. So for it to comply with IFRS, we have to migrate from the revaluation model to cost model. The value were incorporated in the financial records, creating revaluation surplus of 280 million. The property, plant, and equipment of Mainly Limited were originally purchased on December 2018 at a cost of 1.200 million. The asset had depreciated over 6 years on straight line. 6 years depreciation on straight line. The group does not make an annual transfer from revaluation reserves to retained earnings. Now, since the entity migrates to cost model now, let's have property, plant, and equipment. Let me say working 3. Property, plant, and equipment. The entity were using revaluation model before. Model. And the entity has now migrated to cost model. The assets were acquired when? Purchased December 2018. Remember, you are preparing financial statement. The current reporting date is November 30, 2020. That means the year end, the first year end will be November 30, 2019. Then another year end, 2020, making 2 years now from the date of acquisition to the current reporting date, November 30, 2020. So as at the December 2018, that was the date of acquisition, December 2018. So we have December, we have cost of 1.2 million, 1.2. As at December 2019, the entity will depreciate the asset. We had depreciation. And what is the useful life of the asset? The useful life is 6 years, over 6 years. Depreciated over 6 years. So you have 1/200 divided by 6. That gives us 200 as depreciation. 200. If you subtract the depreciation, you have 1,000 as the carrying amount of the property. 1,000. And this property was revalued. As at what date? The property was revalued. So the value were incorporated in the financial records, creating revaluation surplus of 280 million. Which date? So, okay. And restated all, okay. The policy of the group is to state the property, plant, and equipment at depreciated historical cost. The group changed from the revaluation model to cost model under IAS 16, property, plant, and equipment in the year ended November 30, 2020, and restated all its assets to historical cost. So in that year, except for the property, plant, and equipment of Mainly Limited, which had been revalued by the directors of Mainly Limited on December 1st, 2019. December 1st, 2019, just a year after the end of this current reporting period. So you have revaluation now, 2019. Revaluation surplus. Under the cost model, you have revaluation surplus of 280, but revaluation model, other cost model, revaluation surplus nil. So you'll be having carry amount of 1,280, but this model you will still be having 1,000, which is 1 million. Then at the end of the year now, December 31st, so 2020 now, December 2020. So we have December. So we have depreciation, December 1st. Depreciation, we are going to recognize depreciation. 1,280. Remember, the useful life was estimated to be 6 years. Out of 6 years, 1 year has expired. The unexpired life will now be 5 years. If 1 year go out of 6 years, 1 year goes out of 6 years, you'll be left with 5 years. So that's why you'll be having 1,280 divided by 5. Then you'll be having 256. But under the cost model, you still be having 1 million divided by 5. That will still be 200. That will be charged as depreciation. So if you subtract 256 from 1,280, you'll be having the carry amount to be 1024. And this one, you'll be having 800. In our property, plant and equipment, under the revaluation model, we have 1024. And under the cost model, you have 800. You want to migrate from revaluation model to cost model. Therefore, the revaluation surplus, which has been created as a result of revaluation model, you are going to derecognize it. Let's raise the journal entry for that. Journal entry. We have the debit and credit side. So revaluation surplus, you know, was having a credit balance, so you debit it. Revaluation surplus or revaluation reserves of 280. Then, if you look at this now, you want to reduce your PPE from 1024 to 800. So now 1024 minus 800, the difference now. So you have property, plant and equipment, 1024 minus 800. So you'll be having 224. So that means you are going to deduct 224 from your PPE for consolidation purpose. Then you now have the difference will be transferred to retained earnings. Retained earnings. The difference is the excess depreciation. So if you check, depreciation was 256 under revaluation model, but cost model 200, difference of 56. So 256 minus 200, you'll be left with 56. So if you sum it up, here you have 280, the debit side, credit side you'll be having 280 if you add it. This plus this 280. So this 280, you are going to remove it from revaluation. You recognize your revaluation reserves. Now, back to the summary of net asset. Revaluation. Revaluation, derecognize or transfer to retained earnings. 280. So, you know you were having 280 before, so when you recognize it, so it will be eliminated. Then, you have retained earnings of 56. You have to credit retained earnings with excess depreciation. Excess depreciation 56. You credit retained earnings. That means you are adding it to retained earnings, 56. So you sum it up. So the debit side, 800 plus 200, that is 1,000. Plus 280 plus 240 minus 280 plus 56. We have 1, 2, 9, 6. This is 1,000, 1,200. This one, nay. This minus this, nay. This plus this, 96. That is the summary of the net asset of Millie Limited. OMI PLC Group. Consolidated Statement of Financial Position as at November 30, 2020. You are starting with assets, and the first asset you are to start with is non-current asset. Under non-current assets, we have property, plant, and equipment. Property, plant, and equipment. Let me have that as working number 4. We have 4,920, 2020, and 1024. Working 4. Working 4. Property, plant, and equipment. That of OMI PLC. We also have Ruwa Limited and Millie Limited. The property, plant, and equipment of OMI 4920, 2020 for Ruwa 1024. 4920, 4920, 2020, and 1024. Then the next item is the revaluation surplus, the recognized, which is 224. So revaluation from this working, and that is 224. Remember, PPE was credited, so that is why we are deducting the revaluation surplus of 224 from property, plant, and equipment. Then, if you go to the summary of Ruwa Limited net asset, we have trade discount of 24, which was recognized as well. So we have trade discount of 24, recognized. So since we are recognizing it, so we subtract, which led to depreciation. We have depreciation adjustment of 4. So we have depreciation 4. Let's sum it up. So we have 4,920 plus 2020 plus 1024 minus 224 minus 24 plus 4. So we have 7,720. So our property, plant, and equipment. So let's go to consolidated statement of financial position. The property, plant, and equipment is 7,720. Then working 5. Let's calculate goodwill. Working 5. So acquisition of Ruwa Limited. Purchase consideration. How much was the consideration paid on acquisition of Ruwa Limited. We have investment in Ruwa Limited 2,560. 2,560. We had non-controlling interest. Remember, the stake of OMI PLC in Ruwa Limited is 80%. Therefore, 20% will be attributable to NCI. 20% of net assets of Ruwa Limited at the date of acquisition. The date of acquisition, the net asset of Ruwa Limited is total 2,840. 2,840. So 20% of 2,840, that gives us 568. 568. So if you add it to 2,560, we have 3,128. So we now deduct the fair value of net assets at the date of acquisition, which is the same amount, 2,840. 2,840. So if you subtract 2,840, so we have 288. So goodwill on acquisition of Ruwa Limited is 288. Let's calculate goodwill on acquisition of OMI Limited. Remember, we have calculated the consideration paid earlier on acquisition of OMI Limited. We said we have direct cost and indirect cost. So, that of Mili Limited. We have purchase consideration, which is 960 as calculated earlier. 960. We have the NCI. Remember, our NCI was 40%. 40% of net asset. If you check our earlier working, the effective cost of OMI PLC in Mili Limited, which have been calculated earlier. So that was where we got the 40%. So then the net assets at the date of acquisition is 1,200. From the summary of Mili Limited net asset, we got 1,200. 40% of 1,200. So we have 480. If you add the 480 and 960, then you have 1,440. Now have fair value of net assets at the DOA. So which is 1,200 from the summary of net assets of Mili Limited. If you subtract that from 1,440, so you have 240. So our goodwill is 240. Therefore, consolidated goodwill will be, you add the goodwill on acquisition of Ruwa Limited of 288 million plus goodwill on acquisition of Mili Limited 240 million. So you have 528 million. So our consolidated statement of financial position, we have goodwill, that is working 5. 528. So our non-current asset is total 7720 plus 528. So we have 8,248 248. That is the total of our non-current assets. Current assets. Current assets. So the first item of current asset we have is inventories. Inventories. 1,200, 540 and 260. 1,200 plus 540 plus 260. Then go to the note 3. The group operates in an information technology sector and has incurred a significant amount of expenditure on the development of various internet products. Those costs were formerly written off to statement of profit or loss as incurred, but then reinstated when the related internet products were brought into commercial use. The reinstated costs are shown as development inventories. The costs do not meet the criteria in IAS 38, intangible assets, for classification as intangibles, and it is unlikely that the net cash inflows from these products will be in excess of the development cost. In the current year, the Ruwa Limited has included 80 million naira of this cost in inventory. Since 80 million has been included in inventory and the cost does not meet the recognition criteria in IAS 38, so we are going to derecognize it. So now let's remove it from inventory. So minus 80 million. So 1,200 plus 540 plus 260 minus 80. We have 1,920. That is current asset. Then after inventory, the next thing is trade receivables. Trade receivables. 960 for Omi, 420 for Ruwa, 196 for Mili. So we have 960 plus 420 plus 196. Back to note 7. During the year, the directors of Omi PLC decided to establish a defined benefit pension scheme for employees of the parent company and contributed cash to it to the tune of 400 million. The following details relate to the scheme as at November 30, 2020. You were told the only entry in the financial statement made to date is in respect of cash contribution, which has been included in Omi PLC trade receivables. Since the cash contribution has been included in trade receivables, you are going to deduct it. How much is the cash contribution? You were told here for employees of the parent company and contributed cash to it to the tune of 400 million. The cash contribution is 400 million. Since it has been included in trade receivable of Omi, you are going to subtract that cash contribution. It's a cash contribution. Now let's subtract 960 plus 420 plus 196 minus 400. So we have 1176. The next item is cash and cash equivalent. Cash and cash equivalent. So we have 360, 200 and 320. 360 plus 200 plus 320. So that is total 360 plus 200 plus 320. That is total 880. That is the only current assets we have. So now let's sum up our current assets. 880 plus 1176 plus 1920. Our current asset is total 3976. if you add the current asset and the non-current asset of 8248 plus 8248, the total asset is 12,224. That is total assets. Total assets. 12,224. Equity and liabilities. So we have equity and liabilities. Under the equity section of the statement of financial position, our equity includes share capital, 6,000. I've told you that of the parent company only will be used. So share capital, since there are no further issue of share since acquisition. So we have 6,000. Then we also have share premium, parent only, 1,200. Share premium, 1,200. Then we have revaluation reserves. Parent has none, so there's no revaluation reserves. So retained earnings. Our last working was working number 5. So retained earnings will be working number 6 now. Working 6. We have retained earnings. We start with the retained earnings of the parent company as per the statement of financial position. So we have OMI PLC retained earnings as per statement of financial position. Now let's go to the statement of financial position. From in OMI PLC statement of financial position, we have retained earnings of 2,500. So we have 2,500. We now have OMI PLC share of adjusted post acquisition retained earnings of, we have RUA Limited and Millie Limited. Now, the adjusted post acquisition, if you go to the summary of RUA Limited net asset, you have the adjusted post acquisition retained earnings of RUA Limited. You have it to be 260. So now have, remember what OMI acquired. The stake of OMI in RUA Limited is 80%. So we have 80% of 260 million. 80% of 260. That gives us 208. That of Millie, remember we have determined the effective interest of OMI in Millie, and we got 60% the other time. So the remaining 40%, we got 60%. If you look at our working one, first working. So 60% of how much is the post-acquisition retained earnings of Millie? And that is 96 million. For the summary of net asset of Millie, we have 96 million. This 60% is the effective interest. That is our first calculation after the group structure. Though I rubbed it off. That is why I can't identify it with camera now, since I've rubbed off that section. So 96 million. So 60% of 96 million, that gives us 57. Let me say 58, approximately equal to 58. During the year, the directors of OMI PLC decided to establish a defined benefit pension scheme for employees of the parent company and contributed cash to it to the tune of 400 million. The following details relate to the scheme as at November 30, 2020. You have the present value of obligation, 520 million, and fair value of plan asset 500. Since the present value of obligation exceed the fair value of the plan asset, that means you are going to have defined benefit obligation. Let me have working 7. Working 7. Defined, let me say pension obligation. Pension, defined pension obligation. So, and you are given the present value of obligation 520. So present value of obligation 520. Then we also have fair value of plan assets 500. Fair value of plan assets, that is 500. Since obligation exceed the asset, then that means you have you are going to the balance of 20, the difference of 20 is obligation, which is liability. So you are going to recognize the 20 million as non-current liability in the consolidated statement of financial position. Now, let's proceed. We have current service cost, the amount that will be recognized in the statement of profit or loss. Let me have the amount we are going to recognize as an expense in statement of profit or loss. That is in relation to defined pension plan or defined benefit plan. So you have current service cost 440. Current service cost 440, an expense. Then we also have interest cost, scheme liability, interest, a finance cost. Should be interest cost 80. Then expected return on pension asset. Return is an income, so you are going to charge it against it. Expected return on pension asset. On pension asset, return, that is profit. So you deduct profit from it, 40. Then we have actuarial gain, 60. Gain is also an income, so you deduct actuarial gain, 60. So if you net it now, we have 440 plus 80 minus 40 minus 60. Then you have 420. The 420 will be expense in the statement of profit or loss. So we have pension cost. Let me call this working rate. Pension cost, that is working rate. We have 420. So cost, expense, so you deduct it. Expenses will lead to reduction in profit. So now let's adjust that. 2,500 plus 208 plus 58 minus 420. So we have 2346. So our retained earning is 2346. So we sum it up. We have 6,000 plus 12 plus 1,200 plus 2346. So we have 9,546. 546. This is the equity attributable to the owner. Then the next thing is non-controlling interest. Non-controlling interest. That is working 9. Working 9. Working 9. Non-controlling interest. So you have NCI at acquisition of Rural Limited and the Millie Limited. Remember, OMI acquired 80% of Rural Limited. Therefore, 20% will be attributable to NCI. Net assets of Rural Limited at the date of acquisition is 2,840. So 20% of 2,840. 2,840. That gives us 568. Then on acquisition of Millie, remember, if you have gone through our first working in this question after the group structure, I determined the effective interest of OMI PLC in Millie Limited by multiplying 80% by 25%, which is indirect. We got 80% by 25%, that is 20%. Plus the direct cost of 40%, we got 60%. We said the remaining 20% will be attributable to non-controlling interest. So that 20% now, the remaining, since we got 60%, the remaining 40% will be attributable to non-controlling interest. 40% of the net assets of Millie at the date of acquisition is 1,200. 40% of 1,200. If I've gone through the calculation of goodwill, this figure is there. So we have 480. 480. Then we now have NCI, share of adjusted post acquisition retained earnings of Rural Limited. Know the 20%. 20%. How much is the post acquisition retained earnings of Rural Limited? Go back to the summary of the net asset of Rural Limited. We have the post acquisition retained earnings to be 260 million. 20% of 260 million. 20% of 260. That gives us 52. 52. That of Millie Limited. We have NCI to be 40%. 40%. Go to the summary of net asset of Millie Limited. Adjusted post acquisition retained earnings, we have 96. 96. So we have times 96 million. 96 million. 40% of 96. That gives us 38 million. 38 million. Remember, I have told you earlier that the consideration paid by the subsidiary company in acquiring the sub-subsidiary company, I said it to be apportioned between the parent company and the non-controlling interest. I've told you that the parent company share of that cost will be used in calculating goodwill, which have been used in calculating goodwill as an indirect cost. We have used it earlier. While the subsidiary share, the NCI share of that consideration, I said you are going to use it to reduce the figure of the non-controlling interest calculated in usual way. Now our NCI have been calculated. So we are going to have the NCI share of the cost. We now have cost of acquisition. Cost of acquisition. Remember, NCI is 20% times the cost is 400 million. So 20% of 400 million, that gives us 80 million. So you are going to deduct that 80 million from the cost. So we have 568 plus 480 plus 52 plus 38 minus 80. We have 1058. 1058. Non-controlling interest. We have, that is working number 9. 1058. So if you add it to the equity attributable to the owner, 9546 plus 1058. So the total equity is 10,604. 10,604. That is total equity. We have no current liability. No current liabilities. We have pension obligation. Back to our working. Our earlier working 7. We have pension obligation 20. That is working 7. We have 20. Then we also have non-current liabilities. Other non-current liability. We have 540 plus 100 plus 80. So we have 540 plus 100 plus 80. That is total 720. If you add the 720 to the 20, you have 740. That is the total of non-current liability. Then we have current liabilities. Current liabilities. Our current liabilities, we have 400 plus 280 plus 200. 400 plus 280 plus 200. Our current liability is total 400 plus 280 plus 200. We have 880. 880. So if you add the current liability plus 880 plus 740 plus 10,604, we have 12,224. That is total equity and liabilities. Total equity and liabilities, 12,224. If you look at your total asset, you will discover that the total equity agree with the total asset. That is the preparation of OMI PLC Group Consolidated Statement of Financial Position as at November 30, 2020. This is the end of the solution to this question. If you have not liked the video, please don't forget to click the like button. Also share the videos with others. Subscribe to the channel if you have not done so. Thanks for watching ZICA.